Good morning, everybody, and welcome. I've been in office for the last 4 months, and it's really been a huge privilege, a huge honor to have been asked to assume office as the Group CEO at EOH. The support I've received from my colleagues across the organization, from our stakeholders, the investment community and our customers has been really overwhelming, and I'm extremely grateful for it. And thank you to all of you here who have been as supportive as you have been over the last 4 months. In terms of what I've been busy with, I came into the role with a 100-day plan, as I think most guys assuming a role like this would be. It's clearly had to be a very flexible plan. It's had to be dynamic. Some of the key things I've been busy with is I think the first thing was to get to understand our business a whole lot better. And I think what I've learned is quite clearly we've got strength in diversity as EOH. The other thing I did was, just get to know many of our leaders across the business. And I hope to meet many more of them as time goes on. I also had the opportunity to meet many of our customers, our clients, our investors, our shareholders, and our business partners. The other thing we've been busy with as a leadership team is defining our program of action moving forward. And this is really about where we're taking EOH into the future. The last thing was really around reviewing our governance, our risk, and our compliance framework, our processes within the business. And the one area that we are, placing particular emphasis on is our go-to-market from a public sector perspective. And then, of course, enhancing training across the organization in terms of how to better use the tools that we have within the business. In terms of a summary of our financial results, most of you will have seen the Sensima announcement come out this morning. So a really good, solid set of results in my mind. We've seen good growth from a profitability perspective, so really an improvement in margins driven by efficiencies in the business, driven by our own IP and taking our own IP and software to market, and cash up as well. So really overall, I think a pretty decent set of results. Group revenue has grown to almost 15.5 billion now. Really strong business and growth across all segments of the business. So our IT services business, very good, strong growth, 21% up. The software business, up 16%, and good margins in that business. Our IT infrastructure business, a bit of an anomaly because we see this as a commoditized part of our business, but we've had spectacular growth, I think largely driven by the incorporation of an acquisition that was done last year. So we've had the full year of that acquisition in here, and we've had some big one-time deals from a client perspective and some big infrastructure projects. Our industrial technologies business is up 30%, and our business process outsourcing business also well up at 11%. From a profit contribution perspective, again, very good growth across the board. I think varying degrees of growth. IT services, really strong, 46% up from a margins and a profit perspective. Profit in software, as you can see, up a whole lot higher than the top line growth. And clearly, I think the margins in our own IP and the software space is certainly a good prospect for the future. It's something we want to grow into the future, and certainly we're able to command premiums in this part of the business. IT infrastructure up 39%, I think, as a function of the top line growth. And then our industrial technology business, whilst we had 30% top line growth, we've only had 4% profit growth. And then business process outsourcing, some very good growth from a margins perspective. And again, our customers, they outsource their processes to us, largely because we're able to bring efficiencies for them. And of course, the efficiencies are showing itself in the margins and the profit of the business.
So just a reminder, obviously revenue up nicely, as Sinead has mentioned, profit up, earnings per share and HEPS up, which is good. The dividends, we've increased the dividends basically in line with the earnings. And cash, yes, it's up about 29%, but my colleagues will know that there can never be too much cash. It's sitting at 2.5 billion. I'd like that to be 3.5 billion, and we'll get there quite soon. So cash is very, very important, and it's a nice war chest for us to have when we go out and obviously look for new businesses and obviously fuel the operating growth of the business. So this excludes 550 million rands worth of revenue that would have been our share of equity accounted investments. And nonetheless, we are still continuing to grow rapidly. We have strong organic growth. So nearly 2/3 of our growth is organic and about 1/3 acquisitive growth. It's from across the board. It's not one part of EOH that's performing exceptionally well and others that aren't. We're all performing well across the entire group. And it's partially because of our approach of integrated solutions across EOH, providing those integrated solutions to our customers. If we look at the earnings, the operating profit, now the operating profit here excludes, again, the equity accounted profits. So this excludes the equity accounted profits, and nonetheless, up 29%, reflecting increase in our gross profit margins, which are up about 1%, and the margins themselves are up from about 10.8% to 11.6%, so almost 1% up, as is the profit before tax, up a healthy 24%, and again, margins up from just below 10 last year to 10.6 this year. From an EBITDA perspective, even nicer in terms of the margins. The margins up again from about 14% to 15%, which is nice. One obviously always wants to have more and more in terms of the margins. The importance for this slide is to indicate the extent of the amortization and depreciation that we have within the business. Now, amortization is something which you don't get tax relief on. It's an IFRS type of adjustment, and it's also us amortizing to a large extent the identifiable intangible assets that we acquire when a business joins us. That figure is 277 million. So our profits would have been a whole lot higher, and depreciation 171 million. The net interest about 186 million. You would have noticed that we have borrowed in terms of medium-term funding for some of the acquisitions so that we could use our operating cash to fuel continued growth within the business at the rates that we wanted to grow. And tax at 462 million, we've managed to reduce the effective tax rate to just over 28%, the normal sort of company tax rate, mainly because of the benefits, internship allowances that we get from a tax perspective. The purpose of this slide, bring it all together, show that every part of EOH is contributing. This is the EOH model. We all contribute to our success. Just to stand still for a couple of minutes on the new joiners. We always call it new joiners as opposed to acquisitions, and we interchange between those two terms when we have these presentations. You'll see that there's been a trend over the last few years of more organic growth than acquisitive growth. Yes, we are much larger, and that's obviously one of the primary reasons for it. And once a business joins us, we help them unlock their potential, which itself becomes more and more organic. The profit is replicated in that particular model. So both revenue and profit, the same sort of contributions in terms of organic and acquisitive growth. Earnings per share, slightly less than our overall growth, but one would expect that because we do issue shares. When businesses join EOH, we want the former shareholders of those businesses to become part of EOH. We want them to be shareholders. We want them to be your partners within our business, and obviously that has a slight dilutive effect in that process. Dividends increased in line with, as I mentioned earlier, in line with our earnings up to 215 cents and well covered. Our range is generally between 3 and 4 times cover in terms of earnings, so we're sitting close to the upper limits of our cover. So I think that's very, very healthy, very, very responsible in terms of the approach we're taking. I think the other important thing that I mentioned is the gross profit. The gross profit margins have increased by about 1%, which has obviously rippled through in terms of operating profits and obviously profit before tax. I'm now going to hand over to Zunaid to conclude. Thank you.
From a continuity perspective, we believe EOH has strong values, we've got clarity of purpose, and we've got very clear philosophies by which we operate our business. Our philosophy of best people, right first time, ensuring partnerships for life with our customers as well as with our technology partners. Sustainable transformation in South Africa is key on our agenda, and ultimately being leaders and growing in all the spaces that we've defined as the areas in the market we will operate in. I think from a transformation perspective, certainly in South Africa, We've put together a clear roadmap in terms of how we're going to be driving transformation across a multitude of dimensions within the business. So over the years, the group has certainly generated scale across a whole lot of areas in the business, across a multitude of dimensions. And certainly the opportunity is to leverage that scale. We've had a particular focus on working capital management over this last year. Certainly the focus on working capital management is going to intensify into 2018 and beyond. And then in terms of defining the EOH of the future, it's really about getting consistency in terms of how we engage in the market, how we go to market so that we're better able to leverage the integrated elements of our portfolio, so we're selling integrated value propositions to our customers. And certainly from an equity perspective, we need to revisit our equity structure, particularly for the South African operations, from a broad-based Black economic empowerment perspective. Having our own IP and being in the software business is good business, it's strong business, it's sustainable business. And certainly the margins are at a premium when compared with other aspects of the business. I've talked to the disruptive technologies and its impact on our customers. I think we've got a great set of skills, great set of capabilities, and a great set of technologies to help our customers enable their business in a disruptive technology era, because complex system integration is what we do. And we do it really well within the group. And then lastly is just continuing our growth strategy. And our growth strategy is informed by a few aspects. I think the one is being very focused in the market segments that we operate in, so specific industry verticals, specific geographies that we operate in. Organic growth, as you've seen, is really a major enabler for future growth, and it's why we've accumulated and grown the portfolio that we have over the years. And that's enabled by the programs that we've been running now, I think, for the last 2 years around our strategic and key account management programs. Strategic acquisition, so certainly we've got a pretty comprehensive set of offerings and portfolio covering end-to-end value chains within our customers, but certainly there are opportunities to bolt on and bulk up in some areas. We have some white spaces in other areas, and we will continue to grow into new spaces in the market as technology evolves and grows. And then our international expansion is characterized, I think, by 3 things. The first is to leverage the footprint that we have established. We've grown a pretty decent footprint up the continent, very selective geographies, into the Middle East and Turkey, and we've started exploring other emerging market geographies. And on the other hand is the internationalization of our IP. So we've got all this software IP and a great big opportunity to internationalize that. And the last, of course, is expanding into new targeted geographies. So overall, a whole host of growth areas, growth drivers, growth dimensions that we can grow into. We've got a very clear, very deliberate program in terms of how we're going to take EOH forward into the new era. Thank you very much.